just in case it's presented.
I get 2 votes if necessary. And no apologies from other than John Brennan. Welcome, John, being here for Jim. Good to see everyone else. We've got the minutes of our meeting on the 5th of February to consider first, please. I didn't see anything that wasn't in the agenda to pick up today. Daniel? No. Claudette, please.
David, just a note from the minutes. I was in attendance, it just wasn't captured.
Okay, sorry, Claudette.
It's okay. Just so we've got it noted. Thanks.
Yeah, thank you. Any other points or questions on the minutes, please? Thank you. Can I ask for the approval of the minutes? Thank you very much. And on the action tracker, we've 2 items, Daniel.
Yeah, the first one's on EPRR, that's not due until May. The second one is on learning to test update. That's included within Jenny's update from Liverpool Women's Hospital, so she'll cover that when we do the hospital management.
Okay, thank you. No urgent matters arising. Anything you want to say, James, before we get into the main agenda?
No, I think we're obviously going to cover the month 10 update as we normally do, and we're going to give a bit of an update as well on the interim plan because we're right in the eye of the storm on planning, as everybody's aware. We did have a meeting on Monday, which David and Rob and myself attended with the region and ICB to try and further move the plan on. What we've got what we're in receipt of now is we've had a letter back from the national CFO on our reforecast application that we made a few weeks ago, and we've had a letter back from the regional CFO on the plan to date ahead of Monday's meeting. We made some good progress on Monday. What we're going to do is both of those letters will be shared with the board ahead of next Thursday's meeting, Thursday the 12th. Where we meet as a board, and the draft responses to those letters, because there are some inaccuracies that we need to resolve in those letters. But also we'll be able to do a fuller update on where the planning's up to. So we're just going to give a verbal update today, and then on Thursday next week we want to go through the 2 letters we received on the reforecast and on the plan for the year, the latest plan update in some detail with Neds, so we can have a discussion about stretch challenges and things that you would expect there. So today we'll do the headlines, but obviously a big important board meeting next week on the 12th ahead of the final submission date, which is the 18th of March, where we need to put a new forecast in. So that's all I was going to say, Chair. So Rob will take us through the month 10, and then we'll do a bit of a brief update on where we've got to on the planning.
Thank you, Rob. Oh, sorry, Sue first.
Sorry, just a very quick question. Those 2 letters, what are those?
Sorry, Sue, we're struggling to hear you. Is that
I think it's the Susan.
Can you hear me now?
Yes.
Yeah.
Yeah, okay. Those 2 letters that you referred to, James, is one of those letters a letter that was referred to in the letter that Jim Mackey sent us on the 16th of February, where he said he was going to follow up with a second letter directly to us as a trust?
Absolutely, yes, Sue. So that what I said is we had the last letter, then there was we're going to write to you on your reforecast. So we've now received that on, I think it's Friday. And then also we've had a letter from the CFO on the plan. So those were all ahead of Monday's meeting. So what we wanted to do now was, because sending those in isolation without the output of Monday's meeting, was just draw all that together, get it all over to Ned's ahead of next Thursday's board, so everyone's got a chance to look at all those, including the draft responses, and then we can have a good discussion next Thursday on that too.
Perfect. Yeah, that's great. Thank you.
Rob.
Okay, thank you. Thanks, David. Can you hear me? Okay, I will. I'll take us through, as I said, month 10, and also then hand over to colleagues to talk about the site positions as well. Am I okay to share my screen? The board paper is with out with the papers, and we've circulated some slides this morning. But if I share my screen, Chair, if that's okay. Can everyone see that? I'll put it.
Yep.
Yeah. Okay. I'll put it on slideshow. Is that better? Yeah. Okay. Great. So in terms of month 10, as I say, supporting the full paper that is included in the pack. And 3 quick sections. I'll go through the month 10 as normal, giving the overview, and then the sites will talk through their forecast and actions to hit the year end. For completeness, we do include the update for FPRM, which we've got on Monday, which is a combined one, not just looking at this year, but also looking ahead to the plan for the next 2 years. So it's just for completeness. And the third section is again just for completeness, the combined pack for version 2 for the mid-year plan, the multi-year plans that was not compliant, and we've had the feedback on, and we need to do a resubmission on the 18th. But just so everyone's got all the information ahead of them. So in terms of month 10 position, again, to draw out the key points, you can see that in terms of an actual position, we are just short as a group of a deficit of 75 million, 74.8 million. And that's consisted of Luft at 59.6, Liverpool Women's at 22.6, Liverpool Heart and Chest at a surplus of 7.4 at the end of month 10. The variance against plan, if we exclude deficit support funding, and I'll just remind us that deficit support funding, as always, was a system allocated support at the start of the year for £178 million agreed position. And that has been withheld since month 4 across the system. So the excluding deficit support funding, we are off plan by 4.8 million, which again is focused in Luft, solely in Luft, with Liverpool Women's and Liverpool Heart and Chest being on plan. The deficit support funding, as I've mentioned, the impact is for the group is 34.9 million to date, Luft at 26 million and Liverpool Women's at 8.9, and the annual shortfall will be 44.8 if it's not released. It does seem just as that there are organisations now across Cheshire and Merseyside having deficit support funding released, and indeed following a conversation with the region yesterday, it seems that has been offered to Liverpool Women's now, conditional upon us having a compliant plan next year. So new news, but that's what the latest news on deficit support funding. CIP, again, significant delivery across the group, 96 million at month 10. We have fallen behind plan for the first time, and we knew that was going to happen as the final quarter was had heavier CIP targets, but nevertheless a significant position. Luft at 75.8 million, which is 3.3 million away from plan. Liverpool Women's at 10.4 million, ahead of plan by 1.3, and Liverpool Heart and Chest at 9.8 million, again slightly off plan by 600,000. Our forecast group delivery at the end of the year is 132 million of efficiencies in year, which again is really significant, and of that, just shy of 70 million pounds at this point is the forecast full year effect, recurrent full year effect. In terms of the forecast, and obviously we spent a lot of time talking about this previously, the formal resubmission that we had to make to the National Centre was for Luft to miss the year-end position by £15.6 million as a mid-case. And that is our likely case and where we expect to be at the end of the year. There are a couple of elements that we're still talking about that I'll touch on later, but nevertheless, that's our position. Liverpool Women's and Liverpool Heart and Chest both forecast to hit plan, which is really positive. Our cash balance across the group is £63.5 million at the end of month 10. And again, you can see the split on the slides. 13.1 million at Luft, which is around about 3 operating days worth of cash. 800,000, just under £1 million at Liverpool Women's, again about 3 days worth, and Liverpool Heart and Chest, our cash richer element of the group, 49.6 million, which is about 72 days. The underlying deficit and surplus at the end of the year was currently based on month 10 was Luft at just shy of £135 million. That's an improvement from the month before, as we've seen the good impact of the grip and controls coming through in our run rates, and that will continue, and we expect to continue to improve by the end of the year. Liverpool Women's at 36.3 million and Liverpool Heart and Chest at 1.5 million. Again, all of those underlying positions we've got heavy focus on and continue to try and improve. If I just go on to the details, just to pull out a few points, these are the summary I&E positions, and you can see here that the position at Luft and Liverpool Women's versus our plan is considerable. So 59.6 million at Luft versus 28.9 million plan, with a 30.7 million deficit, and that is significant, but that is significantly impacted by the holding back of deficit support funding, as I've mentioned. Same at Liverpool Women's, so 22.6 million versus 13.7 million is the actual plans, but that includes deficit support funding. Liverpool Heart and Chest on plan. You can see the CIPs across the group, as I've mentioned, and the recurrent forecast of just shy of £70 million, and then the forecasted plans, which I'll talk about again shortly. The recurrent positions you can see at month 10 transacted is around about 50% in Luft, which is not where we want to be, but is still significant. Liverpool Women's at 8.1 is about 72%, and Liverpool Heart and Chest at 8.5 is 84%. So really big focus going into the final month of the year, and in month 11 on trying to ensure there's as much recurrent CIP as we can get across the group. This is the run rate, and just highlighting here that effectively, no surprise, because we are on plan with the exception of deficit support funding. Liverpool Women's, Liverpool Heart and Chest run rate is at the level required to hit the plan, and we can see that Luft is on a run rate position about £5 million net. The big impact there is pay is our big driver, which is 5.5 million away from the run rate required on average, and non-pay is largely offset by the income over performance, and includes pass-through costs of around about £1 million a month. As usual, we go through the risks, and we use 3 methodologies. We look at the CIP risks and gap to forecast. We look at an extrapolation methodology, and we have a detailed NHSE or colloquially known Simon Worthington methodology that goes through detailed run rates at the end of each month. And you can see for Luft, that ranges from a CIP gap of around about 11.2 million at the end of the year, straight extrapolation of 28 million pounds, and the Simon Worthington method, which is the one we've relied upon for our expected year-end performance, is 15.6 million, but the range is between 11 and 28. In terms of Liverpool Women's, same methodology, but a lot closer, with a gap on between hitting plan and just and a risk of around about 800,000. But as I've already said, the methodology we've adopted is Simon Worthington's detailed method, and that is to hit plan at the end of the year. And similarly for Liverpool Heart and Chest, you can see there is risk, about £1 million, but we have forecast to hit plan using this detailed methodology. These are the forecasts, and as always, and we do this by site as well as by organisation, we split between a likely, best and downside case for the forecasts. And you can see that for Luft, the position that we've submitted to the national team is to miss our forecast, excluding deficit support funding, by 15.6 million at the end of the year. Upside being 10.8 million, and worst case being just under 20 million. And similarly, the same method across Liverpool Women's, Liverpool Heart and Chest, just shown graphically there. Again, the mid case is to hit plan. So in summary, trading for Luft is off plan by 30.8 million, which includes 26 million due to withdrawal of deficit support funding. Excluding that, we've got the forecast of 15.6, as mentioned, and we've not heard either way actually, but we've not heard that there's any expectation that deficit support funding will be released to Luft for either earned back from quarters 2 or 3 or for quarter 4, but we've not had it confirmed either way. The drivers clearly are pay, offset partly by an overperformance on income, and a significant use of the balance sheet where we've been able, sorry, there's just a fire alarm test, of just over £21 million year to date. The mitigations are continued delivery of CIPs, and all the sites are focused on continuing to deliver the ones that move from red to amber to green to blue as we RAG rate them, and also impact the focus on the run rate adjusting schemes. We have good grip and control now, and we've seen those signs of improvement in month 10. We're looking forward to the month 11 figures and expect that to continue going forward, which is crucial to us. And of course, we're looking at continuing to do the hard to do actions, including we've got continued vacancy restrictions, and there is focus on shutting those, getting out of escalated areas and wards by the end of the year. Hopefully winter will end at the end of March. The other focus point for us is the activity sprint stretch that we've been asked to do, and in fact asked to go further by the regional team, and there's about £1.8 million worth of income associated with that for outpatients. Risks include CIP slippage, and we continue to have conversations with the ICB on income over performance. At the moment, it's 9 million at month 10, and we expect 11 million by the end of the year at the current rate. I've got a meeting with the ICB this afternoon to try and get to a happy medium. We have still not received an activity management plan, so which is unfortunate, and that's our contractual ask from the ICB. But we'll continue to try and have constructive conversations on that point. For Liverpool Women's, Liverpool Heart and Chest, I won't go through this in detail because I think both organisations continue to also adopt the grip and control methodologies that we've put in place at Luft, and are both forecasting to hit plan by the end of the year with all the hard work. So I was going to pause there and then go on to the site forecast and recovery actions. Chair, do you want me to pause or just go on to the sites?
Let's go through the sites, Rob, and then we can just have one conversation. Yeah.
Okay, thank you. So first up, I think, is Pete and Aintree. So Pete, I'll run the slides for you if you want.
Yeah, just next slide there, Rob. Thank you. So I'm just going to do a combination of the financial information in my HMB report and then just talk about the outturn and the mitigations we have in place to hit that. So month 10 position is 12.5 million overall behind plan. That is driven largely by expenditure and particularly pay, offset to a degree by income, where we are 6 million better than plan, 3.1 million in the variable aspect of the contract. Expenditure, as I said, is the key driver, therefore, of the overall position. Pay being 11.4 million worse than plan year to date. That is driven by really three key issues. The escalation areas open for winter, premium costs on one-to-one and WLIs around hitting performance measures and undelivered CIP. All three of those are a key focus of our financial recovery plan, and I'll come back to that when I'm talking about the mitigations that are in place, because we are seeing some movements in the right direction in that regard. Just on the escalation, we have a clear plan to, if we can get those escalation beds closed by the end of March. So as Rob says, winter ends at the end of March. There should be 10 closed by the end of this week, with the clear plans then for the closure of the rest, subject to UEC pressures, which are always variable, but there is a plan in place to get those closed. So hopefully that will make a contribution. And in terms of the final bit on the month 10 position is just CIP. Aintree delivered 2.35 million CIP in month 10, which takes us to 24.9 million year to date. That gives a full year effect of 28.7 million, and 21.9 of that is recurrent, so around about 75%. So that's where we are with CIP. This slide then shows you our forecast outturn. You can see that the mid case is 13.8 million worse than plan. To deliver this, we have several mitigations in place. Essentially, they with the financial recovery plan, they fall into two essential areas. One is delivery of the remaining CIP, as Rob has suggested. For us, that is recovering our repatriation income in orthopaedics. So there's two areas there. One is Warrington and Mid Cheshire, which we've agreed with the ICB, and repatriation from outside of the English NHS. And both of those, the work is mature and started. The grip and control tracker is the other, as we're calling it, is the other key area that we have to work on in a financial recovery plan, and there's 1.8 million to associated with that plan. If we just move on to the next slide, this gives you a flavour of where we are on this. I think we are a lot of the actions that we have taken have now been rag-weighted blue, and actually most of these areas have delivered in Aintree, which is reassuring. If I just pick one out, for example, which is the roster fill rates, and as I referenced earlier, our one-to-one is one of the key areas in our pay expenditure where we are, that is a key driver of the over the 11.4 million that we're behind on pay. That is now mature, and what we're seeing is key reductions in roster fill rates, particularly in our HCAs, and now in the daytime under 100% across as an average across the site, and we're now forecasting that we will recover all of that 370,000 that as we were planned to do in the recovery. So that's a positive. The other areas, as I say, are moving well as well. The two key areas of risk are the WLIs and the non-medical agency, and that's where our key focus is now. The WLIs, all the process measures essentially are in place, and we are now seeing a reduction in the actual WLI rates. That lags behind a little bit financially as this comes through the sort of the system for payment. But we have looked at that in the forecast, and we are now got a reasonable degree of confidence that we will hit that around about 300,000 saving. That is reforecast for us to achieve to hit that 13.8 million. So that's all I was going to say in terms of where we are. So that's the month 10 position, and then the key actions that we are taking in terms of CIP recovery and the grip and control measures.
Thanks, Pete. I think Joe Royley's next. Move on.
Thanks, Rob. I'll take the same approach as we have done from Pete. So firstly, just starting with our month 10 position. So year to date, we have an adverse variance of 15.2 million. We are continuing with an overperformance with our contract income of 12 million, and that includes 6.5 million of pass-through costs. Similar position to Pete in terms of our real pressures sit across, we're above plan from a pay perspective of 14.7 million. This is primarily driven again through underperformance against CIP, our escalation pressures, and some of our premium spend. And you'll see later when we're talking about some of the grip and control that we're certainly starting to see now a significant reduction in our premium spend following the successful recruitment into business cases across a number of our areas. But we'll be able to demonstrate that slightly later. I guess just to note that although we are continuing to overperform from an activity perspective, our income position in month 10 was actually lower than trend. That was particularly driven by two things. Firstly was case mix, because we planned through the month of January, particularly at the beginning of the month, to schedule additional day case activity just to ensure that we had the bed occupancy reductions to support UEC flow at the beginning of January. And secondly, although we'd seen quite a significant growth in our activity, a lot of that was aligned to block rather than to variable. Now, we have identified when we've done a deep dive into January that there is an element of that where there was some miscoding, and that will be corrected retrospectively for month 10 and will improve our position again for month 11. As you can see from this slide here, we've got our best, mid and worst case. As a site, we're forecasting to deliver our mid case position, which would be a 17.3 million deficit against plan. We can continue to mitigate that with the grip and control measures that are in place. We've certainly seen a significant improvement from those grip and control measures, and we've demonstrated in both month 9 and month 10 a reduction in run rate of 500,000. So it's really a positive impact there, and we envisage that that's going to continue for the remainder of the financial year. Very similar position there, as you can see from the Aintree site in terms of the areas where we've got that we are in blue, where we're demonstrating that we are delivering against those grip and control measures in terms of our recruitment freeze, our overtime ban, and our reduction in non-clinical bank and medical agency. The areas really that are a focus of a higher level of risk in terms of delivery for us is the opportunity that's been identified in our retrospective shift booking. This is particularly because although we've acknowledged that there is improved grip and control for the retrospective booking of shifts, we've identified that really there is some double counting potentially, because we can see the reduction in expenditure associated with pay, with bank. So that's why, as you can see in here, this has been RAG rated red in terms of delivery for us. The other area of risk in terms of delivery is in terms of our roster fill rates. And we've referenced in this meeting previously that particularly on 2 of our wards, the acuity reviews have identified that we do need an increased level of staffing in those areas. And the divisional team are currently just working through in detail, a bit of a workforce review really in terms of skill mix and to see how we can address this recurrently going forward. Happy to take any questions. Thank you.
Thanks, Jo. I think Beth, you're up next, please.
Thanks, Rob. Just apologies for my voice this morning, so just please bear with me. As you'll see for DTC, the month 10 position was an improvement on month 9 by 100,000 with a deficit against plan of 550,000. This has led to an improvement in our forecast position of 100,000 forecasted surplus. This continues to be delivered by 3 main things, one being the grip and control measures, which is on the next slide, the grip and control measures which has delivered a run rate reduction of, well, it will be 700,000 up to month 12, and we've already delivered just over 300,000 of that as of month 10. The pharmacy gain share has also been agreed between 550,000 and 600 with the money yet to be received, and also the completing the transaction of the revenue to capital schemes. It was 800,000 as of last month, and we've transacted another 200,000 since last month. The WTE number continues also to decrease, and we've seen a further 18 WTE reduction between month 9 and 10. We continue to focus on getting the strongest position in terms of exit run rate. So what could be made from non-recurrent to recurrent. And we've still got the 3 schemes that I mentioned last year, one being the contract overperformance in imaging, if that's made, if that factors into the outturn next year. Secondly, the pharmacy gain share, if those principles can be made recurrent. And also the third one is about the service we're providing to the sexual health service and testing in ED. And if those 3 things were transacted and factored into outturn next year, they could be made recurrent, which would take up our recurrent position to 60%, which is 4.5% of our cost base. The final thing I want to say is the focus now continues to be that exit run rate and what we can make recurrent, and we are now reviewing all the vacancies, clinical and non-clinical, to help towards that position. Thank you.
Okay, thanks, Beth. And last but not least, from the Luft sites is Jonathan on Broad Green.
Thanks, Rob. So just if you want to just jump straight to the forecast. So for me, the Broad Green plan was a minus 9.1 million deficit. In relation to the gap, it's very much focused on undelivered CIP. The 4 main areas that we're looking at is the winter de-escalation, the grip and control measures, focus on the elective sprint recovery, and then finally just around estates. We haven't seen as quick a recovery or quick actions in around the estates joined up working that I would have liked to have seen, and really now the best, mid and worst case is really around making sure we manage non-pay and our grip and control position. Some of the things that we are focused on is the loan tray position for orthopedics in the Broad Green theatres, but we have seen some impact for that in M11 based on some of the cement national impact overall, which I'm sure Pete will pick up in the Aintree update overall. But it's very short and sharp update for me. It's maintaining the grip and control for M11 and M12 and seeing if we can make sure that we hit the mid case or in best case scenario hit the slightly improved plan. But that was it from me.
Okay, thank you, Jonathan. Chair, if you'd like me to, I'll just quickly signpost sections 2 and 3 and then come back if that works.
Yes, fine.
Okay, great. So section 2, just as noted, we we have the PwC review chaired by Stephen Hay, attended by ICB and Region monthly. We provide an update of the current trading, which we've just gone through. This month on Monday, we're going to be looking at the multi-year plan as well. We have actions that we continue. So these are the actions. There wasn't a month 9 review actually. So these are the actions that we'll be taking into this review. We've now received the finalised report on the balance sheet opportunities. I'm pleased to say that we're actually in excess of the identified opportunities from the PwC have shared with us, which is good news. The forecast we've talked about and incorporate both the enhanced grip and control and CIP, and that's what's come up with our 15.6 million. The ongoing resolution over income, as I've mentioned, meeting this afternoon, we have had an offer of 5.5 million plus 2 million, so 7.5 million potentially against our overperformance. However, we have to recognise that for the activity that we have done, we do expect for that to be paid, and that is within our forecast. So as we've pointed out monthly to the ICB. So we'll hopefully have a constructive meeting this afternoon, but that remains our position. We've also had legal advice that says actually, unfortunately, the contract should have been followed, and the activity management plan had to have been served on us. And if it got to a dispute, because there is a question mark over some of our method of coding, the view contractually is if it was done manually, it would still produce the same report. Therefore, there is no loss suffered by the ICB, or there's no variance. So legally, we're in a strong ground, but clearly we want to avoid any arbitration or dispute. So we'll continue those constructive conversations. We provide detailed balance sheet by month as part of the pack, and at month 10, which we are at 21.2 million pounds, of which in month 10 there was an additional 1.3 million pounds relating to income following a good negotiation and settlement with Speccom, and another 859,000 pounds relating to accruals that we review every month with all the sites and the site DOFs to look at anything that is still existing since the start of the year. And of course, we'll continue to do that going into year end as well. Final items are resolution on the 22 million pounds legal claim. Pleased to say that a resolution was agreed between the region and the ICB. It doesn't change our position because that money was included in our contract, and so our position remains happily unchanged and unaffected in that sense. We include a bridge within the revised pack, and then the two amber items. In our plan, you remember we had a subsidiary option, a commercial option, and just as we were offered an amount from the regional team ahead of us submitting the revised forecast nationally. The regional team are currently reviewing our evidence that we've provided on this, and will continue to have to provide that for the final quarter of the year, which is a bit disappointing, but hopefully we'll get over the line this week or escalate up. And in terms of continued work on impact of capital charges, again, the the work we've shared many times on the new hospital includes around £15.3 million worth of capital charges. Some further information has been shared with Simon, Chris now, and indeed PwC. I had a meeting with Simon yesterday, and he did confirm that he had confirmed to the region, in his point of view, that the new hospital did have a significant cost impact that should be accounted for. But of course, he's only an advisor. And then finally, outlining the protocol on next steps for the forecast, which is complete. So they're just the actions, again, to walk you through, and then very, very quickly, noting the 3 areas of partnership that we've got with PwC, which continue: in-year financial recovery plan, which has led us to the 15.6 million plan, 3-year financial recovery plan that I'll just touch on very briefly in a second, and of course the drivers of the deficit work that identified the structural issues as assessed by PwC for Luft and Liverpool Women's. It is worth just reminding ourselves that the terms of reference for all of that work was completed with and signed off by the NHSE Northwest team. And then finally, just as section 3, I just include for completeness the version 2 group financial recovery plan, again, that we worked alongside PwC partners. And you can see it does explain our methodology. The updates from version 1, our objective of reducing structural cost support over the next 3 to 5 years and eliminating it, and then the removal as instructed of structural cost and therefore deficit support funding. This is just for completeness because, as James has said, we need to resubmit on the 18th as this plan was not compliant. I'll stop there, Chair, and happy to take any questions.
Thank you. All right, so let's just focus on now the forecast outturn, 26 days to go till the end of the year. As James said earlier, we'll circulate the letters and received and the responses that we need to make to them in advance of the board next week. So I won't trail too much of that, but it clearly mirrors our disappointment at having to revise our forecast for the year. But in terms, and there's a lot of ground that you've covered in the paper and a lot of ground that the colleagues have covered in presenting the sites, Rob. But just before I open up, is everything that we've been told here point towards us achieving the revised year-end forecast? Because that was obviously based on the 9 months of the year, and so we've said we need to change it. But are we, everything you know about month 10 and potentially month 11 coming along, are we on course for that?
Yeah, absolutely, Chair. So the things in our control, Chair, I believe are on track, and indeed everyone continues to push as far as they can. One of the big issues previously, you'll remember, was the HMRC dispute that we had, and you'll remember that we had 14 million in our original forecast on that. We did get a positive settlement. HMRC did an estimate of, agreed an estimate of 13.5 million, which is slightly below our estimate. I'm happy to say as well that they've now come back to a position of 14.4 million. So they agreed with our calculation on that as well. So that's further good news. However, the main area that we've got within this forecast of variability still remains the conversation we're having on the income overperformance with the ICB, where they have provisionally offered 7.5 million against a potential position of 11. But I'm hoping they'll be sensible, and we've got a very really strong grounds on that. Probably more worryingly is the commercial offer that we received from the region, and we've followed up with our evidence on that, and there's potential wavering from the 4 million they offered to 4.5 million, sorry, they offered to 1.5 million. So just covering month 12. So we dispute that, because our whole intention was to accelerate that commercial plan, as we've explained, and I've got some further support from that from PwC colleagues, validating that that's what we were going to do, and we talked about that at FPRM. But there remains the two variables, Chair, which are not directly in our control, but we continue to work hard to get to the position we need.
Claudette, please.
Thanks, Chair, and thanks to Rob and exec colleagues. What's really evident is not only the grip and control, but the clear focus that you've all had with colleagues across the various sites to keep us on track. And David's just asked the question I was going to ask, so I won't repeat it, Rob. But my second question was more about the cash balance, and it was when you talked about for Luft and Women's that kind of gives us 3 days coverage. I just wonder if there were any concerns in relation to that, and if you had any sort of views you wanted to share with us on that.
Well,
is that unusual?
So it is unusual. I mean, we are. It's not the place we'd like to be, Claudette. I think if you look at past history, I mean, post-COVID, we had over 200 million pounds in the bank. So, admittedly, that was the other end of the scale. We are suffering. Obviously, deficit support funding was cash backed. So what it means is we go through a distress funding application that does get supported. So it for us, not always at the levels we request, but it keeps us at that minimal level. At the end of the month, we're always at our lowest point because we've paid salaries out, and we get paid at the start of the following month. But we are having to keep daily, we have daily meetings on the cash. We have weekly formal meetings on the cash forecast. We share that with regional and national colleagues when we apply for distress funding. It's something we want to move away from, of course, but unfortunately, as we remain in a deficit position, it's likely to continue for the foreseeable future, unfortunately.
Thanks, Rob. One to keep an eye on, I guess.
Absolutely.
Thank you. Thanks, Chair. I have no other questions.
Claudette, thank you. David, please.
Yeah, thanks, Chair, and thanks for taking us through the detail of this, Rob and colleagues. And it does reinforce what we heard at Audit Committee, that the grip and control processes are embedded in the organisation, and it's impressive, the work that's being done, however uncomfortable it must feel. I just wanted to pull out one thing in your report. In your report you mentioned that confirmation of the VAT reclaim means that Luft has now delivered it, or will deliver its stretch system target for 25-26. I just wanted to call that out, as I think that is a tremendous achievement for the colleagues. We were very reluctant to take on that stretch target, and we didn't have an option for it. So I think that is a tremendous achievement, that all the work we've gone through today picks that up and describes the work we've done. So well done to everybody. Second point is you picked up around the uncertainty around income, and I hear conversations that the NHSE perception of our financial performance is different to our perception of the financial performance. And I just wanted to understand if we've got a reconciliation of that. Is it down to the income that we think we should get that they haven't yet agreed? Can we have an understanding of the differences between our position, the ICB position, and NHSE's position? And the third thing I just wanted to call out before you come in and answer these was you've drawn out in your presentation the various balance sheet adjustments that have gone on, and they're perfectly acceptable, perfectly normal part of the day-to-day running of the finance department. But our auditors have previously questioned whether the boards were cited on these adjustments as they were happening, and I think it's really good that you've drawn those out in the report and highlighted the reason for the changes. So just take you back, if you could give us an understanding of the reasons why those income figures that and are they driving the difference between our view of the world and NHSE's view of the world? Thanks.
Thanks, David. So I don't think our views are necessarily different. I think we're all disappointed that that we remain in a deficit position and are away from plan. I think in terms of the recognition of the income, we have followed contractually what we've done. We've highlighted all year, actually, since the very first month where we were overperforming, that we were overperforming, and there was a methodology to follow, and that's been also a running action actually from the FPRM Stephen Hay reviews. So again, we've not been hiding this anywhere to, you know, as a kind of gotcha moment. Quite the opposite. I think the difficulty is that, well, I can't speak for the ICB, but there is equal focus, is there not, on the delivery of constitutional targets and operational performance. And in fact, we were asked to go further in the areas of outpatients. If we were to have received an activity management plan, which was required, it would have meant us stepping down activity, and that would have had a consequential impact. And again, we've highlighted that to system colleagues. So we think we've done everything that we could have done and should have done in this area. And I think there's just a recognition that there is a stress in the system across the board, and so the ICB are also looking at ways to reduce costs if they can, of which, of course, income to us is a cost to the ICB. So I'm not sure. Hopefully that explains it, David. But I think it's all quite clear. The only other area, of course, where we've had differences of opinion is our belief that structural costs, in particular relating to the new hospital, should have been funded, and remain not.
Mike, please.
Thank you. Thanks, Rob. I want to go back to the audit committee discussion on grip and control, and I want to use this by way of illustration, not criticism, because I think the grip and control is really impressive. So the report that came to the audit committee said that the grip and control was anticipated delivering 7 million of savings. It landed at 4 and then has been improved to 5. And so there's a kind of 5 million of savings versus a 7 million initial indication. And I think it's just in advance of next week's board conversations, just another illustration. I think we are good at financial planning. I think we know what is feasible for us. Our issue is when there's a stretch imposed beyond what we think is feasible. And it is difficult to achieve these levels of savings. If it wasn't difficult, we'd have done it ages ago. So I think it's just a reminder as we get into the conversations next week, how do we keep these things realistic and doable, rather than how do we consistently respond to stretch targets that are imposed but take us beyond what we can manage. Thank you.
Thank you. Agree. Jeffrey, please.
Mike asked the question I was going to ask. I'll turn to something else. When you look at the big picture, clearly the real challenges around Luft, and particularly at the Royal, I think, and the sort of matrix of performance indicators, not least the cost improvement and the low recurrent ones, show well, obviously, well, I'm sure your key management focus will be. Turning to deficit support funding, as I understand it, NHSC will only grant deficit support funding where you're delivering on the plan. So we're never going to get deficit support funding for Luft. More encouraging now for the women's, and obviously the Heart and Chest are in surplus. One point I didn't see, or unless I missed it, was in terms of driving, income, is improving productivity. In other words, doing more for less, particularly at the Royal. Where are we on that?
So obviously that's ongoing. I think in a recent HSJ article, Jeffrey, I think we were shown to have improved in the first half of the year by around about 7.3%, which is one of the highest across England. So we have absolute focus on that. It is though, as you rightly say, and as is pointed out in the kind of model hospital productivity packs, there is still absolute opportunity there, and it's one of our major programs for next year. And in fact, all the PIDS project initiation documents are being developed right now with the SROs as to exactly how we're going to tap into those further opportunities on productivity, recognizing that we can't simply buy our way out in terms of more income. So what it has to be, as much as anything else, is the same, is more activity at less cost, and that's the tricky bit actually in terms of removing that cost. But we've got a plan or plans to do that. It's a major area of focus. I'm sure we'll highlight to you over the coming year as well, Jeffrey.
Sue, please.
Thank you, David. Just a couple of points from me on the deficit support funding. I think I understand the rationale for that funding being released to the women's, but it being withheld from Luft for the time being. But presumably it being withheld is from Luft is on the basis of activity and not meeting plan, in a nutshell. In terms of the women's and that funding being released, I'd be interested to know what it's cost the women's in terms of the PDC, in terms of it being funded that way, as opposed to the deficit support funding being released in the first instance. So I think it'd be useful to just understand that. You've presented the figures for Luft in terms of best case, mid case and worst case, being 10 million, 15 million and 20 million. In terms of those variations in terms of achieving best and worst, is that going to be principally down to activity and achieving SIP? Just want to understand what would have to happen for us to go from the mid case to best and worst, just in a nutshell, and it'll be quite complex. There'll be quite a few factors in there. Grip at control, I won't repeat what's already been said. That's quite, that's embedded. We've had reassurance from PwC in terms of our controls in that area. I've been heartened to hear a lot more about PIDS. I think there's a change in our methodology in terms of how we're structuring our approach to SIPs and sort of cost reduction generally, but I think we should profile that more, and as a board just understand what that change is. Coding, I just wanted to reference coding. That seems to be featuring more in terms of some of the challenges around our funding and our securing sort of funding going forward as well, and potentially some disputes. So it'd be good to see some focus on that. Maybe we could do that through internal audit, just get some assurance around our robust controls around accuracy of coding. And just finally, structural funding. This is going to be an ongoing issue. It has been an ongoing issue in terms of how we manage this. It'd be really useful for the board to receive almost like a bit of a strategy around ideal position and how we demonstrate additional funding from that from the centre. But if we are to eliminate that through our own finances over the coming years, how that would look and what we would need to do, because I'm not clear at the moment, apart from, I suppose, increasing our SIPs and sort of some restructuring sort of projects, etc., that we would actually achieve that, because that's really quite sort of fundamental. So that's really for the board sort of going forward. So there's a few points in there. Some of those I'm happy to sort of take offline. Yeah, thanks, Rob.
Thanks, Tim. All really good points. Rob, anything you want to respond to now?
Well, just quickly, deficit support funding, absolutely. In terms of currently being withheld from Luft, remembering that it was actually withheld across the system, yes, because the system continues to miss its target. Now, Luft will miss its target. Worth remembering that Luft hit its target plan at the end of Q2 and at the end of Q3. So it's only in Q4 that we've fallen short, as those CIPs have ramped up as well. But yes, that's the rationale there. In terms of PDC impact, around about £500,000, but I can get you the detail, Sue. In terms of best case in Luft, it's more a theoretical best case, really, if all our CIPs effectively turn to blue, and the reality is in the final 30 days or however many days we've got left of the year now, that's not going to happen. But that's theoretically if that happened. In terms of coding, absolutely, I think we're heading back to almost like a more activity-based contract and more heavily weighted. So coding is really important. We've actually always been assessed as very good on coding accuracy, so we're happy there. I think the issue is the methodology, because as we are restricting headcounts, as you know, one of our challenges, we're using technology more, and that's a benefit, but it just needs to be recognised, and that'll happen further with EPR. And then structural funding, absolutely, you know, things like the corporate services, things like the estate strategy, I think will start to come together to hopefully reduce our overall overheads across the board. But take the point.
Thank you.
Tom, please.
Thank you very much, David. So one quick question. You're submitting a new plan on the 18th of March. Will we see that before it goes in? And how much more compliant will it be than the one we put in before? Because we knew that one was non-compliant.
Yeah, come on, Tom, now
okay,
to the plan for next year. Thank you.
Okay, thank you.
Answer that. All right, thank you. Obviously a lot of complexity and still moving parts in this, but having made a revised forecast, then all of the above looks as though we are on course. The ongoing discussions with the ICB around activity remain important, and the moving position that region in terms of this commercial compensation, hopefully that can be resolved quickly, Rob. Let me give us an update on those things next week at the board. Thank you. Right, let's just talk quickly then, following your lead, Tom, about the plan for next year.
Yeah, so this item won't take the advertised half an hour, because we're obviously going to do a lot of this in the board session next week. I'm just going to very briefly touch on the discussions we've had on Monday to give the board a heads up as to what we need to get into the detail of next week. And then just briefly, we're going to hear on the governance and WT stuff, but we'll hopefully try and do this by about 10 minutes. So the meeting on Monday was effectively to discuss the plan. Those will remember that we've got an £88 million CIP that, as a board, we've seen thoroughly worked up with PwC colleagues based on the data that came out of the Model Hospital Productivity Packs. So we've got a reliable source, if you like, that's then been externally and independently tested, that gave us for Luft, and it's Luft I'm describing now because that's clearly where the contractual issue is for next year, that then left us with an £88 million CIP and a £51 million gap. Now, at the time, we put that into the regional team, effectively saying, look, there's 51 million that we can't see a route to closing here from the PwC analysis. We called it structural in inverted commas on the basis we'd had the driver's deficit report, and then stated in a letter to the regional team, it would be good to discuss how we now manage this 51 million gap. Now, a lot of weeks have passed, but we've had a meeting on Monday with the team. Now, between now and then, it was made clear that the structural funding needed to be taken out, so it's fine. But that conversation still needs to happen because there are still the cost pressures associated with it. Now, what we've looked at is, there's significant risk to the organisation that a non-compliant plan may result in the withholding of DSF for the whole of next year as well, which would be catastrophic, as we know. So we've tested ourselves to look at what alternative measures can we take on trying to close that gap. Now, why we're in a slightly different place to maybe where we were a month or two ago is we've been recording and reporting and discussing through our FPRM meetings that we expected the underlying position to start to improve through the last few months of the year. And the underlying position obviously is driving some of that gap next year. And for those that are aware of the numbers, in month 9, the underlying position was 144 million deficit in Luft. You've just seen the numbers there, 134.6 at month 10, and we expect that to continue to improve. So the main shift really is our underlying improvement is starting to happen in the way that we predicted that it would. Obviously, we want to see the month 11 numbers to get more certainty on that. But we've also got quite a lot happening through Q4 in terms of vacancies and some voluntary redundancy stuff as well that would all impact on that underlying position and continue to move further than is currently predicted. So as we've gone into the meeting on Monday, we've taken a view that we think our underlying position at year end, with the measures already in place, would land round about the position it was in at the start of the year, which was 119 million, which would represent sort of no material shift in the underlying position or worsening of the underlying position, whereas I think the NHSE view has been that this is continuing to get worse and was heading north of 144 rather than south. So, and that's where some of the discrepancies been that David Gilbert's been asking about, was this sort of judgment of the underlying position or this belief that it would improve. So our current view is that that would improve to about 119 million by the end of the year. That clearly takes a 22 million pound bite out of that 51 million gap, because obviously the original plan was 141 million underlying deficit assumption. So if we move to 119, the gap improves by 22. So we go from a 51 million gap then to a 29 million gap. Now, if you take a look at that 29 million gap on an organisation of our scale, the challenge is going to be right. There's got to be a way to get to something here that benefits the organisation and others, but we've got to be clear on how we do it. So we took into Monday's discussion a proposal that 1% non-recurrent challenge. So we're very clear we couldn't see a route through the PwC work to move the 88 million that's badged as recurrent further recurrently, but on a non-recurrent challenge of an additional 1%, that would be 14.5 million roughly, which is pretty much half of that residual gap. And then we asked the NHSE to consider some of the structural cost of that Robert described before, the capital charges bit of the new building, which I think is the bit that probably everybody agrees there is an issue. Then that number potentially could be the balancing position on that, but that would all need assessment via the information that Rob's already sent off. So effectively, what we said on Monday was, we've got a board session next week. We're going to send some material out in between now and then on the sort of the challenge. But the conversation we need to have with our board is, can we see a way to a 1% non-recurrent improvement in the plan? Clear that 1% delivery would be non-recurrent. And there's some extra things that have happened between last month and this month, which would help us here. So the VR scheme that REMCOM approved on the basis that we might get additional funding for, that additional funding has now been agreed. So that's gone through the ICB this week. So we've now got cover, along with the rest of the system, to use an amount of up to 7 million across the patch to leverage the VR scheme now. Because we're the only trustee who has a scheme in place now today, we've been able to agree to do some of those by the end of March, provided they meet the criteria, and then some in April and May. So we're still working all of that through, but that's a sort of additional benefit that would both improve the run rate on the underlying position, and improve that 1% challenge for next year, what we're currently. So what we want to do is work through the application to the VR, which we're doing at the moment, and the vacancies, which execs have been doing all week. And then by the time we get to the board meeting next week, we should have a sensible view of where vacancies and VR applications fit existing organisational change like corporate services. We would now get potentially the benefit of earlier exit of staff funded with the full recurrent benefits and the run rate benefits associated. So we're going to be working through that over the next few days ahead of the board meeting next week. So just to be clear, we've not committed to that number. What we've said is we need to come back and discuss as a board and take a view as to whether we think it's doable. And obviously NHS England need to come back to us and say, what do they think is the art of the possible around that other 1%, if you like, the other 14.5 gap from a capital charges perspective. But if we can close both of those things, then we could be getting close to a compliant plan. If we aren't in the place of a compliant plan, then there is a national escalation for trusts that cannot meet that, would happen over the next couple of weeks. So between now and then, we will provide the letters on the reforecast and the letters on the plan. Both of those refer to a material deterioration in the underlying deficit into the 140s, which again is our difference of view, which we can see month 10 is sort of concurring with where we thought it would go, and will continue to go. Rob has been working through that with Simon Worthington on behalf of Region this week. So we should be in a good position by next Thursday to consider all of those things in the round and take a view on what we put in on the 18th and can we get close to a compliant plan for Luft. Just very briefly on the women's was 2.5 million off plan, which we labelled structural because of similar well-known and understood issues. That didn't feature heavily in Monday's discussion, and then we didn't know that DSF was being potentially put in place, so that might be a lever to try and ask us to close that gap. I'm not sure. Rob and I will pick that up with Jenny and the women's team, and we'll go through that over the next few days as well ahead of the board. So that's where we are. I think it probably best to just take then the positions on the governance arrangements and the WTE, and then we can have a fuller conversation when everyone's in receipt of all the detail of that over the next few days.
Thank you. So who wants to do this?
So Rob and Jenny, what were you intending to share that?
Yeah, I'm happy to lead off, James, and a lot of the things have been sort of picked up through the conversations. So when we brought the plan to board for approval, there was a request to ensure that the governance arrangements were described as to how we were going to deliver what was an incredibly ambitious plan. So you've seen through the items that Rob's presented is actually in the pack that's gone the approach to CIP this year in terms of the robustness of the PIDs, the support from PwC, the real check and challenge across different aspects, and we've seen it through the workforce workshops about more the productivity and the workforce, sort of triangulating together and making sure we're not double counting. So that's all being overseen by the Financial Recovery Group, which meets weekly, and as they supported by PwC, we've got a roadmap for completion of those PIDs to get to 100% by the end of March. We noted at plan sign off the size of the challenge of the workforce ask, and Heather as SRO has put in a really comprehensive governance structure around delivery of that by those owners of those PIDs and programmes to ensure that stays on track. There was another workshop yesterday afternoon to help develop those PIDs further, again with the view to getting those green by the end of March 26. We recognise that not everything will be in place from the 1st of April, given again the size of the ask, and we've talked about the mitigations potentially through voluntary redundancy that we've talked about, and also the outcome of the corporate efficiency work, which is concluding this month as well. So the governance arrangements are in place. They are incredibly robust from a project initiation document point of view, and I think that's been supported, as I say, by PwC. And then just as a further sort of triangulation point, the business planning group has been stepped up more frequently, particularly over the next few weeks as well, to do that triangulation, recognising that we've still got the activity targets to deliver. We're managing the workforce changes and also the financial implications. So that group meets weekly as well to do that piece of triangulation and check and challenge across the different disciplines, because a lot of the work is happening within, you know, sort of workforce or finance or activity views. So that's really where we're up to. We'll put all this together in that totality of the paper that we bring next week. But yeah, that's probably all I was going to say over and above what's already been said.
Thank you. Jackie.
Can I just ask about, in those governance arrangements, about impact on quality?
Yes.
And being picked up, because I think we're going to see a bit later in the papers about some of the impacts we're seeing on sensitive indicators and wider performance issues. So I just need to make sure that we're badging both of those together. Again, apologies for my...
Yeah. Absolutely, Jackie, and as in previous years, all of the schemes, to get them to green, to get them to that fully compliant, have to be subject to QIA and EIA assessments, which is signed off by the Chief Nurse and Chief Medical Officer. So those schemes do go through that robust process as well before they can be enacted, and that's consistent with our previous processes as well.
I think also that we asked, I think maybe through audit committees, that we see some of those come back so we can be assured as well as non-exec directors. Thank you.
Thanks. I think the other thing, Jackie, that we'll bring through as well is the post-implementation reviews. We can share those more broadly as well in terms of any unintended consequences of some of these schemes as well. We can put that process in through the committee structure to make sure the board are cited on those post-implementation reviews as well.
Thank you.
And Sue, please.
It'd be really good, just on the SIPs and linking in with the medium-term plan, for us to receive a summarised paper on the SIPs for 25-26, just a full reflection of what worked well, and we want to sort of embed going forward into our processes what didn't work. I mean, we've had a few schemes. Liverpool Heart and Chest has been one of the where some of the schemes didn't quite work, but it's just a learning from those, and just to demonstrate, you know, we're a learning organisation and we are building this into our processes going forward, and the fact that we've got this post-implementation review, that's really, really positive. But I think it'd be really good to just get a summary of, you know, how our SIP schemes have worked, and what we've learned from that, and to be built in going forward.
Yeah, great. Thank you, Sue. It's very helpful, David.
Thank you very much, Chair, and thank you for that, Sue, and colleagues. So as part of the work that we're doing in that post-implementation review, as well as the QIA, EIA process, there will now be regular papers to the audit committees demonstrating how many projects have gone through that process, but also the outcomes of those post-implementation reviews. And so I'm just scheduling that with the transformation unit.
Thank you. Mike, please.
Thank you. Alongside all of this, can I put in a strong request next week that we have an item on staff morale at the board? David Gilbert and I had a really it was a really brilliant coffee morning with governors. There are always good coffee mornings with the governors, but the strong theme that came through was just the impact on staff morale. And I think it would be good for the board to be seen to give that visibility next week. So alongside the kind of the technical side of things, can we have something on the human impacts of all of this? Thank you.
Thank you. Heather, please.
Thank you, Chair. We do have staff survey on the board, Mike, for next week. So maybe I suggest that we include that as part of that discussion. I'll prepare something to back that up.
Brilliant. Thank you.
Thank you. Do you want to say anything?
I think we're going to obviously pick this up in next week's meeting, so we'll do it.
Okay, thank you. Need a big part of next week's meeting to do all of the things mentioned. Right, thanks everyone. Let's move on. we get into the site reports now and start with DTC key risks.
Thank you, Chair. So I'll, as usual, keep it brief, and particularly this morning with my throat. So for DTC, we remain to have 4 risks, 12 plus, and all of those risks relate to finance and delivery of the CIP. Just given the financial position that we've reported this morning, we are actually currently in the process of just reviewing that level of risk. Some things that I just want to pull out the report, firstly, is the genomics service and the planned transfer from the 1st of April to MFT. Following a question by David Gilbert last time, I made sure that that was made explicit in our management board, and pleased to confirm that there'll be minimal, if no, impact on patient care. Yes, there will be a delay in the samples being transported to Manchester, but I, and John Brennan is here today, there are very few patients whereby we have to turn those samples round within a very short space of time, and we're exploring options if the patients are in that very, very few occasions of the best ways of doing that. Second thing I want to pull out is the microbiology service review. This is a review by the Royal College of Physicians. It's going to commence in March. It's over a 3-day period, and it will be looking at the service, the rotas, compliance, and the scope has been agreed. The fourth thing I want to pull out is about the Fuller inquiry. All recommendations have now been completed. So that's something to just note. And the final thing is the HSE visit in December identified 2 areas of improvement. We're currently in the process of preparing the final response, which we will be sending by the end of March, along with evidence to support the actions that we have taken. And that's the only things I was going to pull out the report, but obviously happy to take any questions. Thank you.
Thank you. DTC, good report. Questions, points, please. Intent. Mike.
Thank you. Thanks, Beth. Can I just ask about the microbiology service review? So there's 2 questions really. One is, what is the status of this in terms of, it's not CQC level, but what kind of status and weight does it carry? And 2, how confident are we that the outcome will be a decent one? Thank you.
Do you want me to answer, Beth? It's an external review. It's an independent external review that we've asked from the College of Pathologists, not the physicians, it's pathologists. They are due to come in 2 weeks' time. They're going to start on Tuesday, March the 24th. They're here for 3 days. We've essentially got a bit of a stalemate about how the service model and consultant unhappiness, and it's an open-ended review. It is basically to provide an external guidance that hopefully both parties will respect, and then move forward to implement the views of that. You know, we have differing views about how the service could be set up and run, and have been unable to reach a compromise on that. And I think an external review is an excellent way of basically giving us a roadmap to go forward on.
Great, thank you.
Any other points, DTC report? Thank you. Noted, received. Peter next, please, Aintree.
Thank you, David. So the report is there. I just want to pull out probably 4 key issues, if that's okay. The finance we've covered off. From an elective position, just say that is remaining a strengthening position, an improving position. There's no 65-week waits for the 2nd month in Aintree. There's some really good cross-site working going on, led by Beth and her corporate ops team around the 52-week position and achieving the 1%, and also the 18-week RTT positions. So good confidence around Aintree delivering what it needs to do on the 1% 52-week challenge. Reasonable and growing confidence, but challenges within the RTT position, currently at 52.3%, and so some improvement still required, but lots of hard work going on. In terms of cancer, we achieved the 28-day FDS this month, so that's positive. I just want to talk about urgent care. That's risk 93409255. The position really in January remains as it was on the second half of December. If you recall, I described December as a month of two halves. It's a really challenged start, improved second half, and January really continued along that theme. Positive around ambulance handovers with a 40-minute average position. That's probably one of the best positions we saw for a year in Aintree in January. That's further improved in February to 26 minutes. So that's really heartening. Challenges still remain around the 4-hour standards and 12 hours in department, with 44% and 20% respectively in January. That has improved again in February to 48 and 18%, but I think that reflects the winter challenges. Just a quick note on our plans for March in terms of UEC. I've already referenced them in the financial update around really trying to do two things. One is to improve performance in March, and that's we've got a 9-point plan to really focus on the non-admitted performance through our same-day urgent care unit, and to improve our 12 hours in department delay, and also as part of that to reduce the escalation beds as I described when I was talking about the financial perspective. And then the other key part of that is to deliver phase 1 of our acute medicine plan, which is kind of committing to acute medicine and right sizing that. There's a part 1 of that which we're hoping to deliver, which we are going to deliver by the end of March, which then gets us to the starting line really in terms of the flow improvement work that we will see in the annual plan for next year. For Aintree, that's all around getting acute medicine correct and appropriately aligned. And we'll probably pick up some of that more next week. There's just two key themes have emerged that I want to raise in month. One is the orthopaedic cement issue, which I'm sure colleagues have seen in the lay press. We've got a risk there on the risk register now, sitting at 13, which is one of our highest. This is really, as I'm sure colleagues know, is a shortage of the most commonly used orthopaedic cement, which is called Palakos. That's due to a problem at the plant where that was being produced. That's going to last a number of weeks, so that is a challenge for us. As soon as that situation arose, we set up a EPRR-led daily meeting to deal with it, and those are still ongoing on a daily basis. Personally, I've learned a lot about orthopaedic cement in that time. So there's more than one type, and colleagues at Aintree and across the broad green do use more than Palakos, although Palakos is our main cement, and all cements are the same as well. But we use something called CMW2, which again colleagues are happy to use in place of Palakos. Latterly, what's beginning to emerge is that there's some cement called Zimmer that has been procured nationally from France and Spain, and we're starting to get supplies of that now. We had a training day on the Zimmer yesterday. It's not quite Palakos, and some of the consultants are still getting used to that. But in the meantime, we're continuing to procure the Zimmer as a replacement for Palakos. We're also looking at procuring something called SafeSet as well as another alternative. So we're managing that. It's a high risk. We're managing it. So far, there's been little in the way of patient cancellation, which is really good for the patients. Obviously, and just I think it was Claudette's question: is there any risks in the financial plan? Obviously, there is a financial risk associated with that. It's more a patient risk for me, but there is a financial risk which we're managing carefully. And so far, very little in the way of patient cancellations, but a lot of hard work behind the scenes. And I thank the orthopaedic team for the work they are doing on that. I think the second thing I want to raise, and I'm sure colleagues will have seen it on the IPR, which is causing concern on the Aintree site, is pressure ulcers. you will see there's a point on the IPR which is above the upper control limit, so statistically significant deterioration in January. When you look back, there's a similar spike actually in January 25, which prompted us to develop a pressure ulcer improvement plan. The pressure ulcers increase we're seeing is category 2, which you see in the IPR, but we've also got some increase in category 3, disappointingly. And so I've asked Nikki Martin, who's our Director of Nursing, to lead a site-based review of that. So she's gone through some systematic themes, and there are a number, it's multifactorial. There is a degree of winter pressures both in and out of the hospital. There's a real, one of the themes is we need to really focus back on the fundamentals of care and pressure ulcer and skin care. And there's also been some absences in the TVN team as well, which I think have contributed. So it's multifactorial. Our response is to reinforce that and redevelop the pressure ulcer improvement plan. We've also put in place a series of ward-based quality performance reviews, and they've started, and they're 8:30 every morning where the wards come up and we look through all their nursing based indicators and we set an action plan and then hold to account on that. So worrying, but there is improvement plans in place. Just had a look at the February data. And in early indications suggest that there's a 50% reduction in the number of pressure ulcers in February compared to January. So hopefully some of the actions we are taking are providing some improvement. But we will continue to monitor that and push forward as we want to make sure that is a sustained improvement. Just a couple of things to raise before I pause. I just want to bring to the board's attention a potential Never event in Aintree, which happened this week. I'm still investigating it. It's got to do with an NG tube, which was malplaced in the left lower lobe. Now, that's not in itself a Never event, but unfortunately, despite it being checked on an X-ray, it wasn't spotted to be in the incorrect place, and unfortunately the patient was fed down the misplaced tube, and that is a Never event. So we're just looking into what exactly happened, and I will confirm that next month. And then finally, just a couple of things on the IPR. You will see that there's been a slight reduction in mandatory training, which we focused on. There's some divisional elements and some professional elements to that, and we have increased face-to-face mandatory training to try and get back on top of that, and there's improvement plans in place. Sickness absence still running high at 6.93, you will see in the IPR, which is of concern, but again, we have plans in place. And then finally, just on the risks, they're fairly static actually. The new one is the orthopaedic cement, as I've already discussed. The two have increased slightly a month. One is the pharmacy crit care position, but we have approved those posts, and we're just finalising now how the funding envelope is worked out so it doesn't cause any cost pressure. And then so I'll pause there and just take any questions that are the board have.
Thanks, Peter. James.
Yeah, I'm just conscious within the IPR, if you look at luft level, as we always do using the SPCs, we've got 3 areas particularly that are all out of control limit for the first time, more significantly out of control limit, which were the pressure ulcers, CDT and closer look complaints. And if you take a look at the luft sort of explanation of those, because it's sort of fairly factually based. So for example, the closer look complaints as well, largely related to ED, but if you look at the scale and complexity of it, we've had worse ED performance in previous years and not had that level. So I think those 3, it would be helpful for us to take the Royal report as we take it and then come back to actions around pressure ulcers, CDT, closer look complaints collectively, because to give you, and this is why we do it, the reason why we still keep the luft composite reporting is you don't see the statistical outlier for the CDT when you look at Aintree and the Royal separate, but combined you do. So it's really important that we come back to those. So, and I know there'll be lots of questions on those 3. And just to make a point as well, obviously, that we're now in a position where we're starting to get detail on corridor care metrics, which we'll want to put in future as directed by the new 12-point plan from NHSE. But I think in the Royal job, it'd be really helpful just to pick up the 45-minute handover, because that's another statistical outlier this month. So we've got 4 in a month, which is the first time I've had that in a good while. So if we can do pressure ulcers, CDT, close look complaints all sort of together after the Royal. But Joe, in the Royal, could you specifically just pick up 45-minute handover? Because I know that was a challenge. Thank you.
Thank you. Tom, please.
Thank you, David. James just answered one of my questions, which was around the questions of metric for corridor care, because I really don't know how many patients have been cared for in corridors across both sites, not just across one, but also how many patients are boarded out in the Royal and how many escalation beds are open at any one time. I think it'd be very useful to have something like that at the board. I have a specific question around Aintree for Pete, which is I hear that there's a dissatisfaction between, say, the acute medical unit and the physicians in the hospital in general, and they're feeling mutually unsupported. And this has been an ongoing tension there for a long, long time, and it may be getting in the way of patients being moved rapidly on out of the urgent care areas. I don't know whether there's anything more you can do about this, or I'm sure you're very well aware of it.
Yeah, thanks, Tom. I mean, it's a good point, and so this was highlighted in the GIRFT report a couple of years ago, and we have been working with ESIST on that point when they were in place, and it's been part of our internal improvement plan. This year, I'm sure you've heard me mention it, we are talking about committing to acute medicine, because acute medicine at the minute is not right sized. There's probably not enough acute positions. The AMU2 area is too small, and therefore patients are essentially they're getting staying in the ED, and then they are being seen by the specialists, which is I think a little bit of the tension you are describing, or then being boarded up towards because there's no space in AMU2. So that is our key part of our hospital transformation plan this year. We have a plan set out to first of all just make some movements around in terms of where AMU2 is, then with the view to expand that, but also increasing the cadre of acute physicians by reducing some of the spend we have on waiting list initiatives and pods. So that is a key focus, Tom. So it's a really good point. We've been aware of it. We've been working on it with ESIS for a number of years, but we've now got to the point where we're ready to enact really what is the transformational change, I hope, to try and fully resolve that issue. And that will be a key part of the hospital transformation plan, and also is one of the key parts of the length of stay pay that we will see next week as part of our annual plan, because that will lead to reduction in length of stay and bed day savings. Good, thank you.
Mike, please.
Thank you. Thanks, Pete. Just want to ask about the transformation plan, and head and neck and orthopedics are showing it as red, and the commentary says this progress has been made, but the issue is capacity and demand modelling. Were we relying on the LASP or the kind of the merger as the means of resolving that? And if we were, is that now on hold, or can we resolve the capacity and demand modelling so we can make the improvements we want to? Thank you.
Yeah, there was some stuff around the target operating models in that regard, but I think we're now at a place where they're coming to fruition, and the capacity demand modelling has been a sort of a running theme through those two through the year. I'm sure you've seen it on the risks. That it is improving that, and also there's a little bit of the work we're going to be doing around the sort of operating model. How do we do things around here, and a little bit of self-service as well, and that Mike. So we're taking the team down that route. I think that's becoming less of an issue, and really where we're going with those two areas. Because if you look at a transformation plan this year, we made good progress in the acute medicine bit, good progress on the ENT areas, was particularly that you see that through the 65 weeks. There's progress to do yet in orthopedics and head and neck, and they're going to be rolled into next year, and we're just refreshing where we are with those. So, but the business planning issue is becoming less of a concern.
Thank you. Any more points for Peter? As James says, we'll come back to a discussion around this cluster of quality issues that we do. Thank you. Jonathan next.
Thanks, Chair. So for the Broad Green and LHCH HMB, there's 9 risks on the risk register that are greater than 12. I will note that in our HMB meeting, we did note some inconsistency in risk reporting because of the 2 systems that we have within Broad Green and LHCH. And an important factor of us with inheriting DTC in April, we need to figure out how do we do that across the 3 systems and maintain consistency in reporting back to ARC. 3 of those risks related directly to finance, and we've discussed that at the beginning of the meeting, so I won't touch on it in significant detail. 1 was related to performance, and that was mainly in relation to our surgical activity at LHCH and our inability to hit the 52-week target. But we did discuss in the HMB meeting around dermatology and allergy being a specific issue for Broad Green from a sustainability point of view, and going into next year we need to make sure we have a plan. But as Pete has mentioned, as part of the Luft overall plan, Beth is leading that proactive management of how we achieve our overall target. In terms of the quality metrics, there are 3 risks that still remain above a 12. One is patient pass, which is in relation to our urgent referral system at LHCH. We were hoping to have a resolution over the last 2 months, but in terms of digital implementation, we haven't been able to do that. The business case and contract is being reviewed in our capital management group this week, and we're hoping to have that implemented by the end of the financial year. The second is in relation to the Boston pacemaker recall. So we're keeping a close watching brief on that. That means that we're going to have to do a significant number of additional activities on checking patients with those pacemakers, and then looking at how we upgrade them to potential either new devices or check that they are working correctly in an upgrade capacity. So I think it's going to remain as a 12 at this moment in time, and we'll keep a watching brief until we close that. The final risk in relation to quality is the SSI risk that we've seen in both the theatre ventilation in LHCH, as well as in the ALEC wing in relation to ward basic infection prevention measures in the outbreaks of norovirus. So again, I think that will remain a risk until we're able to close it, and you've seen that superficially increase on the IPRs in both LHCH and Broad Green overall. The final 2 risks are in relation to workforce. Final risk is related to workforce in the ACHD service. We have got recruitment plans in place, and we expect that profile to change, probably moving from a workforce risk to a performance risk, and we'll manage that in HMB overall, lowering probably to 11 by the end of the financial year. And then just one in around digital services, because it remains a risk in relation to MIA audits where we've had some inconsistencies. And given our CCC and a digital working relationship with Luft, we're figuring out a transition plan to make sure it's robust going into the new financial year. Important things for me to also note is that going into next year, I do want to just commend all the divisional leadership teams, because as we're going through a period of divisional organisational change, they are continuing to focus on business as usual delivery, focus on annual planning and CIP, and figuring out how we manage a new governing arrangement without having some of that information available to us at this stage. So those are probably the key highlights for me. I'm happy to take any questions.
Thank you. Jonathan. David first, please.
Yeah, thanks, Chair. Thanks, Jonathan. We've read in the media about the problems with the Boston pacemaker. Could you just give us a feel for the numbers of patients involved, the theatre time? How much is involved in fixing these pacemakers?
So in the first tranche of patients, it's about 1,000. So in terms of working through that, it's going to mean that we're doing additional weekend clinics, which is an MDT process with the physiologist and the pacing consultant, because what we'll do is check that their pacemaker is working through the physiology process, and if they need a pacemaker change, the pacing consultant will be available to do a box change at that time. So it's all additional work at weekends, and we've agreed that as a process until we manage all of those patients. What I will warn colleagues and the board on is there has been other upgrade warnings, and we're going to continue to work through that as with the national recall message. There's a balancing act for me of making sure that those patients are seen from a qualitative point of view, but understanding the cost implications and working with the supplier to maintain that as well.
And sorry, could I just supplementary? Is that something, a cost that the suppliers pick up, or should we be notifying ICB, NHSE that there's an additional work we're having to do that's not part of our base contract?
All 3 are being informed, and we're trying to work towards a mutually balanced arrangement of how we manage these. What I will say is a national recall, so the supplier is working with every trust that does pacemakers at this moment in time, so there is a balance of the 2.
Okay, thank you.
Jackie next, please.
Got 2 questions, if I may. The first one is around the workforce and capacity pressures that you've identified here. So I know we don't see the safe staffing numbers as we're doing in the other organisations. So I'm just wondering, is there any issues here about nursing per se, or is this across the whole range of clinical staff? My second question is around the safeguarding assurance being weaker at Broad Green, and I just wondered what the consequences of that were, because they could be pretty horrendous if they're not managed correctly.
So from a safer staffing point of view, those do go to our HMB and they're reviewed for LHC. So I've got no specific concern from a nursing point of view for safer staffing. In terms of a safeguarding risk, we discussed it in our HMB that this was an overall reconfiguration of safeguarding within the group. Although we haven't had a negative impact at this stage, we did want to raise it as a risk potentially if that configuration didn't work and it'd be picked up by the Tom conversation.
Yes, indeed. Okay. And so just around the staffing again, because I mean, yes, it's wider than nursing. So I just want to know if you've got any issues with other staff groups, and actually then by April can we start seeing your safer staffing levels come through the papers like we do in the other organisations?
Yeah, so from a consistency point of view, yes, I can add that in going forward. In a wider staffing point of view overall, so I think I've highlighted, given lots of change at the moment, there is the morale bit, but there's also the bit about consistency of how do we work with those staff overall. The risk that we have at an LHCH site point of view is ADHD because of the niche service, and probably in surgery or in relation to perfusion and ODP. Other than that, I wouldn't say we've got wider staffing concerns. It's those specific areas.
Mike, please.
Thank you. This is a slightly bizarre point, but I was kind of relieved to see the extent of the red risks on this register. I felt up till now we've tended to kind of underreport, so it felt like we might have been underreporting on risk, whereas this feels a much more comfortable level of risk. So thank you for that.
Thank you, Mike. Great. Jeffrey, please.
Thank you. Can you just let us know the palliative care beds you opened and the end of life care beds? Are there any risks around the skill mix of the nurses having a sufficient palliative care experience to nurse the patients?
Yeah, so just in terms of a broader palliative care update, so in January we were up to 6 beds. As of this month, as of yesterday, we are now up to 10 beds. In terms of setting up the palliative care service, it was joint working with Marie Curie, the Aintree team and their palliative services to make sure we had a robust training arrangement in place before we stepped up the beds. So hence we only started with, I think, 3 to start off with, then 6, and now up to the 10. We've had really positive feedback from all of the teams that are involved. No specific incidents that I could raise to the board at this stage. And I'd say again, it's another one of those cross-divisional, cross-site and multi-stakeholder arrangements that we've acted up something very quickly to support a patient population and friend and family group in that kind of area. And it's really another one of a testament to how well it's gone so far.
Yeah, Jackie and I visited recently and the ward recently, and the thing that was most striking is the highly motivated staff wanting to embrace this challenge and do a really good job. It's very impressive. Well done, Jonathan. Thank you. Okay, Jenny next, please.
Thank you, Chair. So firstly, just like to draw the committee's attention to our patient story, actually, which focused really heavily on digital inclusion work, which is taking place across the organisation. We recognise that there's a lot of things moving towards sort of digital and online, and not everybody's got access to that, or is familiar with how to do things, or has digital poverty, so they don't have the equipment to be able to utilise some of these things that we're rolling out across the NHS more broadly, actually. And we've been working with corporate partners, which has helped us provide laptops and SIM cards for people. And we've run education sessions and really thought outside the box, particularly about language and hearing loss. So it was a fantastic story, and there's a lot of learning, I think, that we can share across the wider group. So I just wanted to highlight that to the committee as a great piece of work. Still more to do, obviously, but something we can roll out more broadly across the group. Also to highlight is the financial position. Won't go into a lot of detail. Obviously, we've been through that earlier on in the meeting, and our financial position is one of our high risks, along with cash availability. But just overall, we're consistent with prior months. We're still forecasting to hit plan, excluding the withheld DSF, but obviously we'll follow that up from what Rob's reported this morning. We have seen some increased bank usage, and we've got some really high levels of sickness, particularly in midwifery at the moment, but we are still able to forecast delivery of plan. We've secured the cash arrangements for the rest of this financial year, so now the focus is on mobilising the planning position for 26, 27 and 10 in those CIP PID screen and getting those workforce plans in place. In terms of cancer and elective recovery, also included in our high risk register, it's been a particularly challenging month for cancer. Just to bear in mind, we report on another month in arrears when it comes to that. So this is the month 9 position, this is the December position for cancer, and we did see a deterioration across all 3 of the reported metrics in the summary. We saw Christmas and New Year challenges. We've had some absences as well. But what we can report is we're starting to see that pick back up again subsequent to that. But having had such a challenging month, the impact on the overall performance in terms of year-end targets is potentially more at risk as a result of that performance. What we've looked at is, are we implementing, certainly through the Hospital Management Board, the high impact actions in association with the recovery plan. We've got the weekly meetings and the tiering meetings as well in place, so we'll continue to monitor that. Moving on to elective within that, I think it's great to be able to report that Liverpool Women's has been informed that in Q4 we will move out of Tier 1 into Tier 2 for elective performance, and that I think it demonstrates the effectiveness of the recovery plan that's been in place. We have seen some real improvements. If we take a step further back, if you look at the size of the waiting list down, we're certainly, as of this week, we're around 13,200 on that waiting list. So there's been some real improvements, but still a challenge. Absolutely recognise that, and we won't take our foot off the gas in terms of getting ourselves to the best position we can at the year end, and also moving into 26, 27. The other item to escalate was around a request from board, which came through when we took the Learning from Deaths paper a couple of months ago, and within that it was referencing the Grade B harm incidents, which were included in that, particularly around the antenatal pathway. There was a request from NEDS to go away and review that, which we did through the Clinical Effectiveness Research and Innovation Group, which is chaired by the medical director on site. They concluded that it was more around representing a positive safety culture around thorough reviews. We know that Grade B is an issue in care identified rather than a harm or causative issue, and we are very keen to point out anything that we find and use it in learning, and those which are more serious around harm do go through the usual PSSI process, etc. So there was no issues following that review that was done through that group, but more than happy to take anything further on that. I'll just move briefly, I'll do everything at once if that's okay, Chair. I'll just move into the perinatal safety oversight report, which is there for review, and I've no particular issues of concern to highlight from that. Just 2 things I want to bring to the committee's attention, though. We have submitted the maternity incentive scheme for year 7. That has been signed off internally by James on behalf of the board, which we agreed previously, and has now been signed off by the ICB, and that's been acknowledged as received by NHS Resolutions team around that. We have also last week received an interim report in terms of the findings of the independent investigation into maternity and neonatal services. in England. We've been through that, and we will put this through our governance in terms of our self-assessment against its findings. But in summary, those national findings, we're pulling out areas such as capacity pressures, culture and leadership, racism and discrimination, responses to harm and accountability, and some workforce issues as well. So the family health team have been through that and done a self-assessment against where we are at this interim stage of that report, and we'll bring that back through the Hospital Management Board and form through the Chair's report next month. I think that's probably all I will raise.
Thank you. Jenny, Jackie first, please.
So thank you. Jenny, can we just talk a little bit about the cancer performance and how much off we're going to be at year end? I know we can't exactly predict it, but obviously there's patients on these pathways that are desperate for their care and treatment. And I just wondered how we're going to ensure that no harm comes to them while we've delayed their pathways.
So we do harm reviews, Jackie, on delays. So every patient is reviewed from a harm perspective. Absolutely recognise, Jackie, you know, that whilst we've got performance targets, there are patients at the end of all of these numbers, and we are putting on as much capacity as we possibly can to work through this. If we are starting to see, as I say, we saw the improvement. We've increased FDS back up, the faster diagnosis standard, up by about another 3%. In month 10, so we are seeing that come back through, but it does remain a challenge.
The second thing, if I may, was around sickness and absence, and you're over 8% there now, and I just wondered, and I think Heather's gone now, but you know what we're doing about that. What's the reasons behind it? Is there anything we can do? I'm just trying to not to link it too much to the staff morale bit, but is there any early indications of why it's shot up so much?
So we discussed this at the Hospital Management Board over a couple of months, actually, Jackie, seeing that it's not particularly getting any better. In fact, you know, in some areas getting worse. As I mentioned, midwifery is over 10%. Each of the areas is looking in, and from the family health point of view, because midwifery was so high, there was no particular causal reason behind it, and the split between long-term and short-term hadn't really moved. So I asked at the last Hospital Management Board to do a formal deep dive into that, and is there anything more that we can be doing, or what is it indicative of? But at the moment, Jackie, there's nothing specific indicating the reasons for the increases.
Okay, and then my final question, well, it's a point really. So I spoke to, as I know David Melia did as well, to Claire Matthews, our Regional Chief Midwife, and we were talking about an external visit that's coming at the end of April, and one of the things that's still bothering them, and I think we need to do some work on it, is around embrace and stillbirth deaths. They still can't understand how we're still shown as a big outlier. And I know we've done loads of work with Birmingham and Manchester Foundation Trust and others, but I think we need to be prepared for that. But also that we've got some really great stories to tell now, and I just want to make sure when she comes, and I'll be there all day as well, that we do those balance, because they're going to get a lopsided view of Liverpool women's. Yeah. Thanks.
Thank you. Thanks, Jackie. David, next, please.
Yeah, thank you, and thanks, Jen. A really clear report. Just a relatively small thing picking out from here. I'm always impressed when I come to the women's, and when we talk about the women's services, about the Honeysuckle team and the services they provide. You've given us two examples here, two tragic cases on the perinatal oversight report. You do flag up in there was an issue with a bleep about calling the team for one of the cases. Could we have some assurance that we've taken some learning from that, and that shouldn't, you can't say it never happened again, but it shouldn't happen again? Thanks.
Yeah, so it is an issue, David, that we're acutely aware of. The bleep system is no longer supported in its current format, and there is a working group working through that in terms of, so we have got mitigations in place for should that happen again. But there's a whole point around, we recognise that the bleep system's not where it needs to be, and estates and digital are working through that. We should have a solution relatively soon, but I can bring anything back on that. But yeah, we've got an issue with the bleep system.
Yeah, could we have an update on that when you've got the solution, please? Because it does sound, just reading that detail, it does sound a very, very worrying.
Yeah,
and stranding some of our staff without the support they deserve.
We know the cause, David. We're just getting the solution in, so we can bring that back.
Thank you.
Mike, please.
Thank you. Can I go back to the cancer plan, please, Jenny? So absolutely echo Jackie's point about these are people, and that's the most important thing. It's felt challenged for a long time now, and that we've really struggled to deliver to the plan. And so I think from a governance point of view, it raises the question either have we got the right plan, or is the plan doable, and should we be looking again at how we're delivering this? Could we have some kind of update on where we are with the plan and what the barriers to delivery have been, and what is the prospect of actually getting to the plan? I know it's under weekly scrutiny, but I don't think we give the same scrutiny at the board level. Thank you.
Absolutely, and we know, Mike, that the gynecology is a very challenged speciality when it comes to cancer, and obviously with us being a single tumour site, we will always not be reporting particularly well. If we're benchmarking reasonably well in terms of the gynecology tumour group, we can see that improving, but obviously overall we don't have other tumour sites to be able to sort of offset some of that performance. But you're absolutely right, the targets that were set and the targets that we can do are always stretching, and in next year's plan we have got additional ambulatory capacity coming on board. That was phased through the business case, we knew that. What's been really, the plan itself has been achievable in terms of on paper. It's not been a plan that's not been undeliverable, but we have had a few issues around particularly consultant sickness through November, December and January. We think we had about 5 gynae consultants off at one stage. We had the non-obstetric ultrasound issues going through the CDC as well. So there's just it's been multifactorial. I think we will always set ourselves an ambitious plan because we need to be pushing ourselves, but it is difficult to deliver. So absolutely, we've got it. We can see exactly which bits have performed and which bits haven't against that recovery plan and against those trajectories for delivery. Mike, and more than happy to share that.
Thank you. It's very important. Beth, please.
Thank you, Chair. So I just wanted to make a note that we do see it's a seasonal deterioration that we see in cancer performance over the December and January period due to the reduction in capacity over that time. So I am saying if you look at year on year, there is a seasonal dip. However, what we've looked at is that seasonal deterioration is much less than what it has been in previous years. So just wanted to make that note. In relation to the cancer performance at the women's, we are looking at not just the capacity issues that Jenny's just referred to, but also the clinical pathways. So there are ladies who are waiting. And for example, we've introduced the HRT pathway, which has streamed ladies who are a suspected cancer to the appropriate place. So that capacity that we do have are for the ladies who have been diagnosed with cancer. So there's an awful lot going on, not just with capacity, but how we can actually stream and make sure the capacity that we do have are for the ladies with cancer, not just suspected cancer. Sorry, Jenny, just wanted to add that in as well. Thank you.
Thanks, Beth. Very helpful. Any other points on Jenny's report? Great. Is there anything else you needed to raise, Jenny? Oh, okay. Thank you. It's good. To Jo, please. Gordon.
Thank you, Chair. So if I start from a risk perspective, that we're currently carrying 22 risks that are scoring a 12 or above across the site. 9 of those relate to finance. The remainder are fairly static, except for 3 risks that I'd like to start the meeting with, please, with regards to our UEC performance. So you'll see that risks 9430, 9300 and 8788 have all appeared for the first time on the risk register for us today. They've increased from a 10 to a 12, and they all really correspond with the increased UEC pressures that we've seen across the site throughout January and February. And they relate to either the bedding of assessment areas, the reduced capacity within the emergency department, or the situation where regrettably we have been holding some patients in the back of ambulances for extended periods of time, which, as you know, for us as a Royal site is something that really we haven't been in that position previously. As we've already mentioned, obviously we would expect the seasonal pressures that we would normally experience. Throughout January and then increasing, I would say, even into the last couple of weeks within February, we've really seen increased pressures and stagnant flow within the site. We've maintained our 4-hour performance pretty statically. So our all type performance has been at 75.49% and our type 1 performance has been at 52.9%. But as has already been referenced, we have seen quite a significant deterioration, not only in our 12-hour position, but also in our 45-minute ambulance handover time delays. So as people will be able to see from the report there, we have increased from previously reporting, it's been an increase of 518 cases of patients being held beyond the 45 minutes. So the total number for us in the previous month of December was 887 patients, which is obviously a very significant increase for us. I'd say there's a number of factors that are really particularly influencing that. We haven't seen an increase in terms of our attendances, but we have been working closely with NWAS because they have, in response to increased demand within the city, they have put 6 additional crews on the road, and they're at a particular time frame where we're now seeing quite a bottleneck in the number of ambulances that are coming to us at a real peak time, mid-afternoon into early evening. That coupled with on site, we've seen an increase in our length of stay. We've seen an increase in our no criteria to reside. Our length of stay, particularly for our super long length of stay of 100+ length days, has increased for us. In response, we've put on some super MAID events over recent weeks to try and start reducing our no criteria to reside, because we had quite consistently been holding our no criteria to reside on site at around 12 to 14%, whereas now it has gone back up and it's escalated back up to 20%. So between the super MAID events, working with our system partners, looking at our own internal delays, and also looking at when we will be able to access the additional 42 beds that are being opened across the community bed base over the forthcoming months. Now, although 42 beds, we're delighted that that volume of beds is being opened. The phasing and their ability to actually accept patients from us is really quite slow. So it's sort of 2, perhaps 3 patients across our 2 sites that they can take per week. So again, we're just having some discussions with them in terms of how they can potentially support increasing the flow of discharges off-site for us. Just in terms of further, whilst I'm on A&E, I suppose I would just draw everybody's attention to, as we already referenced, the increase in our closer look complaints. As referenced in our assurance report, we've reported the highest number for the reporting period of 31. And again, that was particularly when we looked into it in relation to patient experience of being cared for on the corridor, and also the increase in the number of boarding patients that we have across the site. So again, that is just reflective really of the pressures that we're experiencing. From a performance perspective for electives, we continue to maintain a really strong position. Our 18-week position is reported at 67.8%. We've had no patients reported over 65 weeks, and our 52-week position remains ahead of trajectory at 0.66%, with a total of 165 patients who are waiting over 52 weeks. We're really on trajectory and in a good, strong position with our elected position. DMO1 is sitting at 8.28%, which is really fairly static compared to previous months. As Beth's already made reference to, we have seen that slight deterioration in our cancer performance, which is associated with that seasonal deterioration that we normally have over December, both through the reduction in capacity that we have associated with the Christmas period, but also acknowledging the impact of the industrial action that we had at the tail end of December, and the element of patient choice in terms of declining appointments over the Christmas and festive period. We've seen our 28-day faster diagnosis drop slightly to 69.8%, and our 62-day performance has dropped slightly down to 69.8%. We are on trajectory to start recovering that position from the January and February position that we'll be reporting in future months. I did want to just highlight our deterioration in sickness absence, particularly within short term, because that is now contributing to 52.2% of our overall sickness absence across the site. Now, whilst we absolutely accept that we would normally experience some seasonal deterioration in our sickness absence position, as you'll be aware from previous reports, we have got 312 risks on our risk register that relate specifically to our admin and clerical vacancies, that due to the fire break that we had in Q4, we've really encountered significant stress and increased workload for this particular workforce. And that's where we've seen a particular increase in the sickness absence from a short-term perspective across the site. We're pleased to confirm, though, that following the review of the vacancies that we have been holding as a result of the fire break, we are now progressing following recent review a number of vacancies to help alleviate some of the pressures in some of our most challenged specialties that are reporting a 12 risk on the risk register. Just in terms of a couple of other key issues to just escalate, some really positive news there is reported in terms of our ILQA position. So we now have 18 of our inpatient areas that have been assessed across the site, and we're delighted to report that 96% of the areas that have been assessed have all achieved either silver or gold status. The new well-led element of the standard as well really reflects the strength of ward manager leadership. And as reported in the document, we've scored 94% against that standard across our areas. So really demonstrating the strong professional leadership that we have driving clinical standards across our wards. And then the final area really just to acknowledge is that we continue to work closely with Jenny with the planned integration with the Women's Hospital with the Royal site, which is planned due to take place from the 1st of April. We've been having consistent review of sort of the governance structures across the two sites currently and the two HLTs. We're progressing all the arrangements now to integrate those governance arrangements from an assurance perspective from April. And although in the report it makes reference to the HMB being split up until May, Jenny and I met with Holly yesterday, and we've confirmed that that will actually be effective from April. So from an ARC perspective, from April reporting into May's ARC, we will be reporting as a single HLT. I'm happy to take any questions.
Thanks, Jo. Well done.
Thank you.
Please. James.
Yeah, I think we obviously we've got a task to de-escalate the Royal site during March anyway, but I would suggest, given the scale of the handover times and the waits on the corridors, which I know historically the Royal has been very good at this, we just need a bit further assurance on that next time. So obviously we'll be at the back end of, the very beginning of April when we next review this, but we'll take a closer look at what we're managing to do, because it's concerning that if it's a glut of ambulances, then it's a glut of ambulances. We still need to deal with that problem, don't we? So we'll bring some further assurance back at the next ARC on that. But It's, you know, when things just give you a feeling of there's something not quite right here. And it does feel like that because the Royal has historically been very good at the flow side of things. The numbers aren't up. The timing of day issue exists, but I know Joe's been looking at the overnight weights as well. So I think we just need to bring some further assurance back to ARC next time.
Thank you.
David, please.
Yeah, thank you, and agree with James there. It does feel as if the Royal's under enormous pressure, and disappointed to hear from Joe that the patients with no criteria to reside are back up to 20%. As a NED not involved in the detail, it feels like, you know, the blockage at the back door is causing the problems at the front door. And I just wonder, is there anything extra that we can do that can be done to bring a focus onto these, to get them back to the still uncomfortable levels they were before?
So the impact of the SuperMade event that we're having, we've been doing that now for a couple of weeks, and we're now starting to see the impact of that. So we are starting to see us returning back to increased, improved turnover time for ambulances, reducing the number of times that patients are waiting in excess of 12 hours within the department. The site is still particularly pressured. We're still boarding quite significantly, but we are starting to get flow back through the department, particularly over the last week. We're working very closely, David, with system partners in terms of, again, being able to access this additional capacity that's coming online within the community. And again, working with particularly local authority in terms of social work support for some of the assessments for some of our most complex patients that we've got. So we're certainly getting the support that we're reaching out for from system partners to take this forward.
Thanks, Joe.
Okay, thank you, Joe. Peter and then Jackie.
I was just wondering whether I wanted to come back to the points that James raised. Maybe it's what Jackie wanted to do as well, but let's come back to the sort of the key bits, the three key areas that James raised early on in the meetings. Is that okay? Shall I do that now, Chair, or just to give my view of from an interim perspective? Yeah, okay. So I think pressure also I've covered, so I'll be taking any questions, and I'm sure there are some. Can I just talk the CDT issue? There was 14 cases in Aintree in January. That again is multifactorial. Some of it is driven by the norovirus outbreaks that we had, and that's increased testing, so you do see more CDT positivity. However, there's two key things drive CDT. One is antibiotic stewardship, second is cleaning and fundamentals of care type issues. Nothing signalling on the antibiotic stewardship bit when we've looked into it. There are some issues that Nikki is liaising with the estates facilities team, Lee Salary, etc. on the cleaning. There's particular an issue that I think if you look at Aintree, we're using slightly old style curtains, and I think we're going to move to the disposable curtains. I think will make a big difference. We have a ward upgrade plan, which now we've got a ward close we can crack on with, if you like, just because there's some sort of estates environment issues I think we can start to put in place. But the key bit short term on that is making sure that the ward managers are getting the cleaning that they need, and so really pushing on escalating cleaning concerns. If you're not getting what you need, raise it with myself, Nikki, and then we will then liaise with state and facilities. So we have been putting that in place. Actually, what we're seeing is hopefully we're beginning to see a bit of a reduction in that number again coming into February. So that's the key issues there. In terms of the closer look complaints, I think as Joe said, when we looked into this, it was boarding and it was weights in ED. And if you recall, in back end of November, early December, Aintree was under pressure, and I think those are the complaints just coming from that period. That's the key driver, is the boarding and the weights in ED is what's raised those complaints. So all that sort of action plan I've described around our UEC plans is the plan to improve that, just to try and give you a flavour of the work we're doing on that. We are spending quite a bit of time now on our HMB on quality because of these signals that are coming through, and really trying to get this back in everyone's mind that we must really improve these key measures. I think as you say, we've seen the three elements go off, but we're really working on getting them back on track through the measures I've just described.
Thank you, Jackie.
So I'm just wondering, Pete, because we had similar conversations last year and around this. So I'm wondering, what is the issue when we've got quality improvement work going in and quality improvement teams there, that we're slipping back, because it goes back to Joe's point about made events. We know what works well, so why can't we do it day in, day out and do it right first time? And I'm just not getting the assurance that perhaps I'm looking for around how we get this going. And it may be a question for the nursing teams with the nurse sensitive indicators, but when we've got the LQA, which Joe again has said for the Royal is really good, but how do some of those really important clinical care events impact that? Because we can't say with gold and silver and then have this sort of thing going on. So I suppose it's a question for a few people to answer, but I think that's where my concern is coming.
Thank you very much. And really just coming in on that, Jackie, I think that when we've had a look at the issue in its totality, you know, the focus on that maintaining the quality improvements has been diverted by other factors, and that's not an excuse. It's what's happened, and we're trying to bring that back so that focus is clear all the time. What we've identified, there are some particular areas within each of the organisations that are having the greater difficulties. It isn't exclusively, but it would tend to be those areas where there is escalation, either escalated beds or escalated care areas. And that in itself isn't the sole issue. Some of it is coming down to that local leadership and that local scrutiny of practice. And so I know at Aintree, Nicola's put in some actions, immediate actions around, for those particular areas, having a greater presence of more senior nursing staff throughout the day and night to make sure that what should happen is happening. And that's equally around doing things like around in the middle of the night to make sure that patients have been moved, patients are being cared for appropriately, and that staff are appropriately distributed across the ward. Something as fundamental as that we would think that would need to be or should be managed just at ward level. There are some things around understanding the impact of that leadership and then addressing that within some individuals as well. That isn't the sum of all the improvements that we need to take, but for those very immediate areas, I think it is important. But we do need to regain that focus of, as we did 3 years ago, around that quality improvement cycle.
Because what we don't want is that the mid-staff issues coming out. We don't want that. We've been focusing on money and missing the quality.
Yeah.
And especially when we're showing such good staffing levels, which is into, and we're managing that with really high sickness and absence. So I think there's some stuff there that the triangulation is not quite matching up.
Indeed.
So your focus on that is really welcome. So thank you.
Joe, just to draw this to a close, because obviously we've got some time next week as a board. I think it'd be useful to say, because there's something about that. If you look at all the parts of this now, this is the first month we've gone out of control limits in these 3 areas. So sometimes, occasionally, this happens and then it all returns to normal. This feels a little bit more challenged than that now. We could have the right staffing levels, we could have the right LQA scores. One of the recurrent themes in here is when we're under intense pressure, those things slip, isn't it? And I think it's that thing of how we start to get assurance on how can the system cope with those smaller periods of intense pressure. Because every time we've seen a control limit issue like this, it's tended to be at the peak of the winter months, boarding, congested corridors, etc. But if we've got cleaning concerns, that's an unacceptable position, isn't it? That's, you know, we can be busy, but that has to be prioritised. So I would suggest the thing that would be really helpful is perhaps just for David and Pete and Joe, we've got board next week. I think it'd be really useful just to give a flavour of the board next week of the 3 or 4 high impact things that we're doing now this month to hopefully see an improvement. So we see that SPC chart come back to the normal control limits. So maybe if the 3 of you could just put that next Thursday, these are the things we're doing, and then we're all clear what those interventions are, and then we can track whether they're having the impact that we would like to have. It'd be really helpful.
Which I agree. We can turn Jackie.
Yeah, thank you.
Okay, thank you. Right. corporate risk.
Yeah, I'll be brief, Chair. There's a couple of new ones on here. There's three that I won't go through because we've discussed them before, and they have plans in place. The two new ones were about the staffing challenge around resident doctors, national pay dispute, and the fact that we then had letters about further strike action, although the dates haven't yet been set. So we're obviously hoping for some sort of national resolution here. We're still able to cope when we have these issues, but the longer it goes on, the more difficult it is becoming to help to get people to be able to staff those areas. And the second one is the corporate nursing risk that we've been discussing really. Now, again, this isn't a new risk. We've had corridor care challenges. We've had well understood measures in place. CQC had come and looked at and tested that are safe. However, as we've now got a set of criteria nationally set on this, and we're clear how it's going to be measured, it's of increased importance that we can demonstrate that we're able to do that. So the reason that's got a school there is that we know what those measures are. We're going to start to report those measures imminently. It's not that we think we're going to be an outlier in that regard, but it's more about that, okay, now we've got that number and the board can see that number, what do we do about it? So we wanted to raise that to 13, get that into the board, get that into the IPR, and then see what the 12-point plan that's nationally being driven and our response to that, which David's leading, will take us into some actions for the board to oversee. So they're the two new ones. The others are previously discussed.
Thank you. Clear. Points, concerns, questions, Jackie?
So just quickly about the new one around corridor care. Obviously, I was at the event last week where it was being taught to, and a lot of the Northwest organisations run on the trains going down. I think one of the big things we discussed was about being clinical-led organisations, but operationally enabled.
Yeah.
So we can't do it without each other, and real discussions around calls to actions about how we were going to do that, how we were going to make it part of our social movement. Everybody's focused on it because it's not just ED's issue, it's the organisation's issue, it's the systems issue. So for me, it's about when we do our action plan, that's going back to the 13th of March, I think it's due back in, unless we change the date, then it's about recognising that this isn't respectful and dignified for patients having to be on corridors or boarded out or wherever, that we put the patient at the centre of that action plan as well, to show that we are that caring organisation that I know we are, but I think we just really need to demonstrate it because that cultural bit really came over at that event.
Yeah, we've got the action plan being developed for the 13th, so again, it will be ready for us to have a look at on board.
And tomorrow we have our senior leadership forum at Aintree Racecourse, where we normally have about 120 senior colleagues, both clinical and non-clinical leaders. And I'm doing a session on that at first thing in the morning, just past 9. And part of that isn't around, well, it isn't around, this is what we are structurally going to do around moving this to that and the other. It is around that impact on the person. So we're starting off with the patient, a very, very clear patient story about the impact on being cared for or experiencing corridor care. And then we're talking about some of the things that the sites are going to do, but we are going to be focusing on, so what can you do? So that there's a personal responsibility of all our senior leaders, no matter what matter role they have in the organisation, to contribute to us having a safer, more respectful care.
And I've been invited by Rebecca to go around ED at Aintree next Thursday morning before board. Right. So if anybody else wants to come round with me, they're very welcome.
Thank you. Okay, good. Anything that we need? We've covered a lot of the issues in the IPR in the discussions.
We deliberately picked out the sort of statistical changes as we normally do, Chair, and those ones we discussed earlier with the key issues.
Any other, Beth, was there anything you wanted to highlight that we haven't covered in the discussion so far?
Thank you, Chair. No, don't want to delay people anymore. We have picked out, I was just tracking what everybody's saying. Probably just the thing to finish off and taking Jackie's point around, where the performance, just on the final couple around elective. I think it's just worth noting that We have we had a meeting on Monday with all the sites around what our end of year position might be for 18-week and 52-week. And just to report that while still ambitious, we have plans to try and achieve the 18-week. So it is challenging, but we're not it's not unrealistic and unreasonable. So we're still chasing that with a number of challenges in certain specialties. And we are more confident for Luft of delivering the 52-week position. As of the end of last week, we were 1.38 and we need to be 1%. So that is looking promising from the commitments that we've made. And from the women's point of view, I know we've touched on cancer, but I think it's worth noting they are seeing significant improvements on the elective programme. And I think there is every chance that we will get with the plans we have in place to the 1% for 52 weeks. And I think we might be about 4% short on the RTT, but where we've been is a significant improvement on that. So I just wanted really to pull that out, given the report I provided last month. Thank you.
Thank you. Any questions of Beth, please? Okay, all good. Don't think we've any other business done.